Welcome back to Your Money Matters. I am your host and publisher of the Bauman Letter, Angela Durrell, and joining me are Ted Bauman, our editor, and Clint Lee, our research analyst. Now, first, just real quick to let you know, Ted will be releasing his next profit switch recommendation this week. So if you want to get in on that, I definitely encourage you to click the link below or above. You can see what kind of winners he's been uncovering, but not only that, we actually disclose the full open model portfolio. And I know we get lots of questions there. So in the very least, if you want to check out the portfolio, I invite you to do so. Now, moving on to today's topic. We sent out a poll to our Bauman Daily readers to ask if they thought a collapse was coming and if they were preparing for one and how. Now, interestingly, I was not expecting this, just 14% of people said they did not expect some sort of crash this year. I didn't think that was going to happen. On top of that, we've been getting emails from our readers. We got one from Jessica S. And she just asked, are our ETFs going to be safe if the market crashes? I'm really nervous. And then we got one from Gaitan, who's a Bauman Letter subscriber. He suggested that we create a no matter what steady portfolio. A portfolio that would be good in any sort of market, good or bad. I believe it's time to do so now while the markets are stronger, rather than after a 35% correction. With that in mind, I would love to get some ideas from you, Clinton. We'll start with you on some sort of all-weather picks.
Yeah, sure. Look, I understand the nervousness that's still out there with everyone, with many of our viewers. I get it. Earnings so far hasn't been enough to make the markets look cheap, right? I mean, we still have incredibly excessive valuations out there in stocks and just euphoric behavior in certain areas of the market. Everything that we've seen with, GameStop's rise and subsequent collapse. I know it's making a lot of people nervous, but there are still some great opportunities out there. And a lot of it has to come down to, or a lot of it does come down to a sort of sector rotation and looking at what sort of variables are at play to influence that. And so the one thing I'm looking at right now, I think you're seeing this convergence of three catalysts, I guess is what I would call it. One is just all the stimulus spending that's coming our way. And we had a $900 billion package at the end of last year. We've got a $1.9 trillion package that Biden's put forth that I believe the House is set to vote on today. We'll see if that gets watered down in the Senate some, but that's still a huge amount of money. And then supposedly, what's that?
Last night, yeah.
Oh, dude. Okay. And then after that, once they get this COVID relief package in place, they're expected to turn the attention to an infrastructure bill with a price tag of $1 to $2 trillion there. So these incredible sums of money. The Fed still has its foot on the gas pedal. Rates are at zero. They're buying a $120 billion per month in securities. And at the same time, you got the vaccine rollout, which has had some challenges. We know that much. But we're seeing more vaccines come to market. J&J seeking authorization for theirs. And so as that picks up, we can start to look to a reopening of the economy, hopefully sometime during the summer. When that happens, you have all this pent-up savings over the last year. That totals over $1 trillion there as well. So just putting it all together, and I think you can find some great opportunities in the more cyclical kind of deep value areas of the market. And the one I would start with is in the energy sector. I would look at something like XLE for just broad energy sector exposure, because we've seen oil prices rebound here. OPEC's done supply cuts at the same time. If you get this infrastructure package, you get a reopening of the economy. You're going to see increased demand for oil at a time when supply is being constrained. That's going to help American producers. And so I want to show a chart of XLE right here because, when it comes down to timing, I think right now is a great time to take a look at this ETF. And that's because, for starters, once again, it's kind of a deep value pick. We've only recovered about half or so of the decline from the highs going back to the end of 2019. And, one of the things I want to highlight why now is a great opportunity is because of the resistance at this $45 level. I'm highlighting that with the arrows on here. We had that level hit right after the initial rebound off the lows. Then energy stocks kind of went nowhere, trading sideways. But then just over the last month or so, we've come right back up to that level. We pulled back, but we held support of that 50-day moving average. That's the purple line. And at the same time, the MACD indicator in the bottom panel of this chart, that's indicating to me that momentum is about to pick back up. So I expect a breakout over that $45 level to happen here soon, reflecting everything that's going on once again with the stimulus and the vaccine rollouts and the economy reopening. And there's one more cyclical area that I would pay attention to as well, and that's with steel companies, especially as it comes down to an infrastructure package. And you can get exposure there with the ETF SLX. And I want to show a chart here as well, taking this back a little bit longer, going back about 5 years or so, because once again, we can talk about these themes, but it's the timing of when you get into these that's so important. And I think right here's a great opportunity because we have this $50 level from 5 years ago when we came right back up to it, what I'm highlighting with the arrow on here. And then I got the thumbs up. We held support at the purple line, the 50-day moving average. The MACD is kind of resetting that zero line. So what that's telling me is that we are in a great area to pick up shares here to start that run back toward that $50 level and looking for a subsequent breakout to new highs from there.
Clinton loves that MACD. We can make a drinking game of this, but you can't argue with results. Ted, what are you looking at?
Well, first, I just want to respond to Gaitan's observation about an all-weather portfolio. I mean, I think what we're presenting, what Clint's presenting, are opportunities in a recovering market. And I think just to go back to what Gaitan was saying, if you want stability, he knows, being a Bauman Letter subscriber, that we have made recommendations in the past in short-term treasury funds, for example, daily funds that will basically maintain your money. So I would just say, Gaitan, go back and look at those. Once you move beyond those kind of things, nothing is certain. So there's no such thing as a can't fail stock, but there are ones like these that have the best chances of accumulation. So I want to present two today, and one of them is based on deep value, and the other is based on the likelihood of policy changes. The first one is the RMR Mortgage Trust, ticker RMRM. It's interesting. It's a closed-end fund, which is different. It's not a REIT at this point, but it's being converted to a commercial mortgage REIT right now. It's going through the process with the Securities and Exchange Commission. It's deregistering as an investment company, and then it will re-register as a REIT. But here's the thing, once it does that, it's going to get onto the REIT indexes, and people are going to notice that it is trading at a 50% discount to net asset value. Now that means that its current price is 50% below the actual value of the assets that it holds. And when people see that kind of deep value, particularly for something like this, this is what happens. Here's a chart that shows the typical response when any kind of a REIT is below 10 or 20% below its net asset value. Those are the 10-month forward returns. So basically, you're seeing the possibility of at least sort of sort of 10, 20%, whatever, that kind of average around 16%. But in this case, you're looking at the possibility of 100% gains. And let me show you a chart that shows why. Here's a chart of RMRR. Again, it's a mortgage trust, but it's an unusual one. It doesn't just focus on individual households. It does commercial mortgages and high quality ones. So you can see that huge drop at the beginning of April last year. And then it dawdled along, but it's starting to recover. If you look at that far right-hand corner, basically the shorter term averages, the exponential 21-day is just recrossed above. It's headed for the 50, and that's a good sign. I think we're going to see this one pick up. But the bottom line is, when it converts to a REIT, the market's going to notice and go, "Ooh, hey, big opportunity here." Get it now before that happens. In fact, get off this video and go buy it right away. I know I sound like what's his name from CNBC, but that's the way it should be. All right, the next one is Hannon Armstrong Sustainable Infrastructure Capital. That is a ticker HASI. It develops and sells sustainable energy infrastructure projects that meet mandated targets. And that could be things like energy-friendly buildings, energy-friendly hospitals, solar installations for large companies. Essentially what it does is it develops them, and then it either sells them to them, so that it gets a loan repayment, or it leases it to them So it's very similar to a lot of the property trusts that operate in the commercial sector, like the hospital trust. Now, it's been on a strong uptrend. It's pulled back a little. Here's the chart. You'll see it's pulled back a little bit below its 10-day moving average, but it's popping back up against it on a weekly chart or above it. So that's a good sign. The market wants it to be higher than that. But the key thing is that it's an obvious beneficiary from public policy right now. So if we see strong energy mandates and strong mandates to improve energy compliance, carbon emissions and all that, this is an obvious pick. So there you are. There's two of them that I think are going to do well.
I noticed you had the MACD in those charts, Ted.
Well,
I'm getting drunk over here.
You spend enough time with Clint, you get MACD, and you start looking at weekly charts. That's what happens.
All right. Well, that certainly is a lot of great information today. And it's a good reminder for everybody watching that if you do have questions, if you see topics that you want us to cover, please email us at baumandaily@banninghill.com or leave it in the comments. That's your first call to action there. Your second one is to go by, what is it? RM, what is it?
RMRM.
There you go.
Yeah.
And then your third is to click the link and be sure to watch the Profit Switch Summit now. Thank you so much for watching. We'll see you next week.